Glickman Retail Group, Real Estate Investment Advisory. Retail Market Research, Quarter 1, 2013. National Outlook. Mixed signs of recovery. Since the recession, most economic indicators are tracking at or below average relative to other recoveries. Economic indicators. Unemployment rate is at 7.5%, the lowest since December 2008, after April's increase of 176,000 private sector jobs on top of the loss of 11,000 government jobs. Most new jobs were added at the retail and business services, but still 12 million are unemployed and 8 million are classified as part-time employees. Consumer confidence improved, demand held up. While housing and auto sectors are accelerating after years of turmoil, major sectors such as manufacturing are still showing signs of trouble. Personal savings rate, 3.9%, up from 2.5% in 2012 and 1.5% in 2011. Inflation under control, but commodity prices still volatile. Consumer debt rose to a new high of $2.8 trillion in January, mostly due to school and auto loans. Corporate profits hit historic highs while wages continue to feel the squeeze. Corporate capital spending remains restrained. Banks willing to push out debt maturities of bad loans. Equity markets up from stronger corporate profits. DJIA reached 15,000 on May 3rd, its first new high since 2007. Risks remain U.S. fiscal policy, local government austerity, Eurozone, global QE, and artificial stimulus, geopolitical, Middle East, and more. Federal Reserve officials forecast the economy will grow by 2.5% in 2013 and 3.5% in 2014. And due to the mixed signs of this slow recovery, the Fed will likely keep federal fund rates near 0% until mid-2015. On the retail front, the influence of technology, demography, and economic conditions has created sweeping changes in where and how consumers shop. E-commerce now captures a greatly expanded role in retailer sales and strategies. New concepts, the need for local fulfillment centers, and retailers' expansion help counterbalance shrinking store counts and smaller footprints, and filling up big box store spaces that have been vacant for a long time. Most retailers remain focused on efficiencies. Forecasts for retail sales will increase 3.4% in 2013, down from the 4.2% growth in 2012. The food index reached a new high in August 2012 after the U.S. suffered its worst drought in 25 years. Retail sales grew 0.1% in January 2013 from December 2012, and 4.4% YOY. Online grew 15% in 2012 and expected to grow 9 to 12%, compared to 3.4% overall. New store growth is limited. New construction remains near record low levels and rent gains are still anemic. Lackluster improvement in vacancies. Mall vacancy rates declined by 30 basis points to 8.6% in December 2012. Strip mall vacancy rate was 10.7%, just 40 basis points off the high of 11.1% in 2011. Notable retail store openings. Rue 21 Inc., 122. Chipotle, 160. LA Fitness, 60. Trader Joe's, 54. Chico's FAS, 110. Tractor Supply, 91. Darden Restaurants, 129. Ross, 79. Dollar Tree, 295. Family Dollar, 446. Dollar General, 558. Aaron's Inc., 105. Walgreens, 255. Walmart, 95. Big Lots, 31. TJX, 143. Notable retailers closing stores. Blockbuster, 650. Christopher & Banks, 138. Delhaize Group, 97. Limited Brands, 96. Men's Warehouse, 31. OfficeMax, 23. Safeway, 37. Office Depot, 18. Radio Shack, 49. Foot Locker 35, Rite Aid 46, Kroger 11, Macy's 6. Capital markets. Favorable spreads relative to the bond market, low interest rates, and the revival of CMBS will facilitate a solid rise in retail transactions in 2013. Secondary and tertiary markets will capture greater deal flow aided by CMBS capital availability. A 200 basis point spread between primary and tertiary markets and larger investor allocations to value-add strategies will encourage deal flow. The year is off to a strong start with $72.8 billion of significant commercial property sales in quarter one, representing a 35% increase from a year earlier and the second highest quarterly volume post-recession. Greater diversity among lenders and falling interest rates helped fuel the investment markets in 2012. Competition among lenders is expected to intensify in 2013. CMBS financing, coupled with growing lending by regional local banks, has helped fuel two significant trends: increased investment activity among private buyers and the increased transaction activity in tertiary markets. Approximately 42% of all loans for retail properties in 2012 were originated for CMBS, much greater share than for other property types. National banks increased market share the most, and although many of those loans may end up in CMBS issues, the revival of lending among regional local banks is also significant. The volume of outstanding distress for retail loans declined 12% in 2012 to $26.1 billion. Workouts will accelerate in 2013. Retail transactions, strong rebounds in select markets, and a slowing of appreciation in markets where prices are nearing or past peak levels. One-off sales of retail properties totaled $6.2 billion in quarter one, up 9% YOY. Transactions involving strip centers also reflect a positive trend, up 20% YOY. Overall, cap rates for the retail sector were relatively unchanged in quarter one. Investment shifted to higher-yielding secondary markets. Prices for anchored centers and single-tenant properties are rising faster than for other retail property types. The Tampa-St. Petersburg-Clearwater MSA is comprised of Hernando, Hillsborough, Pasco, and Pinellas County. Located on the west coast of Florida, the region includes one of the busiest ports in the southeast: Tarpon Springs, Ybor City, Busch Gardens, University of South Florida, University of Tampa, and many tourist attractions. According to data provided by the U.S. Bureau of Labor Statistics, BLS, seasonally unadjusted unemployment rate is at 8.2% in November for the Tampa-St. Petersburg-Clearwater MSA, down from 9% in June 2012 and over 11% a year earlier. Moody'sEconomy.com reports a fourth quarter of 2012 average household income of $96,882 for Tampa Bay, compared to an average household income of $124,481 and $113,580 that are reported for the top metro areas in the nation and South Atlantic. The housing market is improving, with home sales up 18% in January year over year. Sale price has increased by 13% in 2012, with over 40% of the transactions being foreclosures. MSA population, 2,824,724. Population growth estimate, 1.3%. Unemployment, 8.2%. Employment growth estimate, 1.9%. Average HH income, $96,882. Tampa-St. Petersburg ranked 99th of 102 metro areas surveyed with respect to strength of economic growth. Tampa Bay fell into an economic swoon well before the national recession sunk the nation as a whole. Tampa's recovery from the recession, while clearly underway, has been similarly weak but should continue. Tampa Bay's recovery, if uneven, should continue. Additional progress in housing and in the construction sector would be helpful. Bereft of substantial high-tech and manufacturing sectors, those that now help with recovery at the national level, Tampa relies on traditional low-paying industry sectors, tourism, and services. A substantial change in this pattern is not expected. The heated development activity in the Tampa Bay retail real estate market seen prior to the recession and led by large format projects in the Wesley Chapel area of northern suburban Pasco County has yielded to a period of quiet as the market heals its recession-inflicted wounds. No retail space of any type completed construction in 2012. According to REI's March report on individual Tampa area retail construction projects, activity is picking up but slowly. 2 neighborhood centers with a combined total of 175,850 square feet were under construction per report date. 1 million square feet of regional center space are planned for the South Shore Commons area. Vacancy, while declining, remains elevated at 11.6%. The fourth quarter rate was down 20 basis points from the quarter before and was down 60 for the year. Rent growth has turned positive at $14.28 per square foot and $12.51 per square foot. Respective mean asking and effective lease rates for the latest quarter were up 1.4% and 1.5% from a year earlier. While things should improve, 2013 got off to a slow start. January's 23,000 square feet of negative net absorption contributed to a 10 basis point increase in the vacancy rate, along with respective declines of 0.1% and 0.2% for the mean asking and effective rents. Power Center vacancy ended the quarter at 5.9%, up 40 basis points for the period. At $22.49 per square foot, the fourth quarter mean asking lease rate for non-anchor Power Center space was down 0.1% for the period. Although expectations are for gradual improvement in the community neighborhood sector for 2013 as construction proceeds prudently, while the vacancy rate slowly declines, little change is expected in rates of rent growth for the year. Sales activity has been uneven and skewed by certain small transactions. Mean selling price of $218 per square foot, but only $54 million traded hands in 9 transactions this quarter. Mean cap rates remain at 7.8%. The 12-month rolling cap rate per this quarter was much higher at 10.4%. The information in this report is deemed to be reliable. Every effort was made to obtain accurate and complete information. However, no representation, warranty, or guarantee, expressed or implied, may be made as to the accuracy or reliability of the information contained herein. The author, Sean Glickman, CCIM, Managing Director of the Glickman Retail Group, Director of Retail Investment Advisory at Coldwell Banker Commercial. Sean Glickman is a real estate strategic advisor and an investment sales expert. He specializes in the shopping center industry in Florida, has a global real estate investment and development background, and is considered to be one of the foremost experts in the retail real estate industry. Sean is a graduate of the Shopping Center University at Wharton School of the University of Pennsylvania, a member of the National Retail Group and the International Real Estate Council, ICSC, CCIM, CIPS, and ULI, and is the Director of Retail Investment Advisory Group for Coldwell Banker Commercial. Sean's primary focus is on helping clients create wealth through real estate investments. He provides consulting, underwriting, and investment strategy to the world's largest institutional retail owners, REITs, and developers such as Brixmor, Kimco Realty, Casto Lifestyle, Westgate Resorts, Lamar Companies, Poloni Development, Phoenicia Development, Northeast Companies, and more. He has relationships with most institutional, international, and local investment firms such as Rita Development, Weingarten, Equity One, Cole Capital, DDR, Woolbright, Kite Realty, Global Fund Investments, Star Poland, Gazet Galab, Bezer Group, Africa Israel, and many more. Sean has built his business as a leading retail real estate investment expert thanks to his business intelligence and as an accomplished investor developer for over 10 years, unparalleled market knowledge, and his analytical capabilities. His client's success is always his top priority. Visit us at www.glickmanretailgroup.com. We are experts in institutional-grade investment services. As your objective advisor, our primary focus is to help you make the most effective investment decisions. Working with our team, you will maximize the value of your assets and create wealth for you and your investors.